Disney stock slumping in the after-hour session Thursday after the company reported its fiscal second quarter financial results. Welcome to Variety's first quarter media earnings coverage. I'm Heidi Chung, media analyst and correspondent for Variety Intelligence Platform. It was a rare, disappointing quarter for Disney. Even as the company reported a beat on the top and bottom lines, its streaming service, Disney Plus, reported lower than expected subscriber growth. The company reported adjusted earnings of 79 cents per share on revenue of $15.61 billion. VIP Chief Media Analyst Andrew Wallenstein joins us to break all things down Disney and its latest quarter. Andy, we have to start with those Disney Plus subscriber numbers. Wall Street was expecting 109 million subscribers in total, but the company only reported 103.6. In your opinion, was this a one-off, or does this signal more trouble ahead for the company?
Well, the Disney Plus subscriber numbers are particularly underwhelming, but I got to tell you, this would have been a lot worse had Netflix's Q1 subscriber levels had been equally underwhelming. So Disney Plus doesn't really look that bad by comparison. Netflix smartly warned investors way in advance that pandemic lockdowns would create a pull forward effect that would see subscriber levels surge early, then peter out as early 2021 kicked in. That's exactly what happened. So here's Disney Plus now kind of singing the same song. And so it almost feels a little excusable. Also, you have to keep in mind, let's cut Disney some slack here. They had quite a rocket ride for an entire year. There was no way that trajectory was going to keep up for that much longer. So I don't see this as a humongous miss.
So to that point, there are some things that would be a positive going forward for the company in the second half of this year, as well as 2020. And one of those things is the content strategy that management really laid out on the earnings call. So the company is leaning into that day-to-day strategy where they're releasing films and content directly on Disney Plus, as well as in theaters. And Chapek actually saying that come August, we're going to start to see an exclusive 45-day theatrical window for a couple of films that are coming out. So your thoughts on this strategy, and do you think that's really going to help things pick up its pace in the second half?
Well, the day and date strategy for the upcoming movies like Cruella and Black Widow, I think is a reflection of where the market is in terms of the pandemic. Obviously, Disney would love to have those in theaters even before Disney Plus, because that's where the real money is made. So I think the much more significant announcement is what's going to happen with movies like Free Guy in August. Shang-Chi is the other one. And there's a 45-day exclusive window. And that is hugely important because Disney is really the pace car when it comes to the studio exhibition marketplace. We could very well see a 45-day window, which obviously is much shorter than the exclusive window that exhibitors had before the pandemic. This could be the standard going forward, which is pretty bad news for the exhibitors. I would imagine their stocks are going to take a beating in the coming days because there is no more important product than Disney blockbusters. It's not even close.
And Andy, another bull case for Disney going forward has to do with two new sports rights deals that were announced on Disney's conference call with the MLB as well as La Liga. So I wanted to get your thoughts on that and how significant you think that is for Disney going forward.
Oh, it's certainly significant. Not so much for Disney Plus. I think the story here is ESPN Plus is getting really two very nice assets. Disney for a while has really been on a roll. They brought in the NFL. Bob Chapek even indicated on the call with analysts that they were going to take a look at Sunday Ticket. So I think ESPN Plus is becoming a really more and more important piece that, especially as we talk about a slowdown in the growth trajectory of Disney Plus, we very well could see ESPN Plus start to pick up the slack.
And Andy, we have to talk about Disney shares because if we're thinking about 2020, the stock had a massive run up, a lot of it boosted by the pandemic and those stay-at-home orders. But it's a lot different when we're looking at this year. Shares were basically flat headed into earnings. And now with the slump that we're seeing in the after hours, it's negative on the year. So I want your thoughts on what you think can really drive shares back to the upside. If at all you think Disney will go back to record highs this year.
I'm skeptical about record highs. If you think back to what we saw in March, where Disney cracked the 200 billion marker, Disney Plus was riding high. I'm hard pressed to say Disney is going to come back that far, but I think they can get close because I think the third quarter will be a much better story for Disney. I think the parks in particular, you cannot underestimate the importance of the parks to Disney's bottom line. And by the third quarter, you will see that major parks will have been open for quite a while. I think that's not necessarily going to be all the recovery that Disney needs to do, but it will go a long way. And I also think that production having resumed will also help Disney across not just Disney Plus, but also the linear channels. So a better story to tell. I think Disney growth is ahead. I just don't know if it's going to be record growth.
Yeah, we'll have to keep paying attention to whether that road to recovery is as significant as people say. Andrew Wallenstein, VIP's chief media analyst, thank you for joining me to break down Disney's latest quarter. And for more in-depth analysis, head over to variety.com/VIP.